makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. China's factory output unexpectedly contracts in July, while home sales drop the most in a year. Beijing pledges to boost private credit. BP raises its dividend by another 10% and says it will buy back another $1.5 billion of shares despite missing profit estimates with weaker oil and gas prices. We'll bring you more of our interview with the chief executive, Bernard Looney, plus another $2 billion in buybacks for HSBC shareholders as the bank's second quarter pre-tax profit actually beats estimates. We'll bring you our interview with the chief executive, Noel Quinn.
Those results are a function of good revenue growth across the globe. All of our global businesses had strong revenue growth. All of the product lines within those businesses, strong revenue growth.
Now, also coming up, our exclusive interview with Bank of America's international president. He's Bernard Mensah, and that's at 9:30 a.m. London time. He'll be joining us here in the studio. Now, let's take a look at the European markets map to have a look at where we fall in terms of earnings. Again, it's been a busy fortnight in terms of earnings that disappointed. Overall, most of them actually did a little bit better than expected, but when you disappoint, you get slammed by a lot of investors. Happy August, or will it be? Well, while European stocks have rallied over the past 2 months, seasonal trends also have historically pushed the Stock 600 down in August and September. I think we have a chart looking at that very thing. And then RBA, it's paused. The Central Bank of Australia decided to not raise rates. Deutsche Bank calling it the end of that tightening cycle. The next test is on Thursday. Traders split between the BOE hiking 25 and 50 basis points. I keep on hearing this is definitely going to be a decision on knife edge. And then more pressure in China. Property developer Country Garden said to have canceled a share placement. Worries are growing about the company's liquidity and the country's overall property sector. Now, compounding concerns, of course, the Kaixing manufacturing PMIs showing a contraction in July. Well, joining us to talk about the markets, to take stock of the week that's been and the week that's coming, Guy Foster, chief strategist at RBC, Brewin, Dolphin, Bloomberg, Sofia Orta Acosta. So thank you both for joining us. Sofia, you're an expert on everything China. I don't know whether, and I know we have the PMIs and the Kaixing, which are worrying. I'm really worried about a possible default or something in developing, in this developer world. Is the PBOC going to have to support them, or are they happy to have these like bursts, bubbles being burst here and there?
I think that's what the market is trying to understand, Francine. I mean, Country Garden, the developer that you mentioned, it was the biggest developer in China by contracted sales. So it's not a small developer. This is kind of, when you consider how much the market was panicking over Evergrande 2 years ago, and now something like Country Garden happens and we're all kind of calm and carry on, it really kind of shows it shows that China has kind of managed to manage this downturn relatively successfully. I think there is some concern still about defaults here. The fact that Country Garden was trying to sell shares into a market that was supposedly more positive. We were, in a kind of environment where people were looking at China's stimulus and looking at what Beijing was doing to support the equity market as a positive going forward. Country Garden had to cancel that share sale plan. So it really shows that it's very, very fragile sentiment in the market right now. Also, Francine, the property sales data out today, down more than 30%. There's still so much work to be done there.
Yeah, and this is what I don't understand, is that actually, are we reading it right? Right, when you look at China, and with Sofia's excellent explanation of what's happening with some of the property developers, should we be more worried, or is there just a general belief that authorities will deal with it?
No, I don't think there is that general belief. I think there's, as Sofia sort of explained, I think there's real confusion about where the government's stance is, or where policymakers' stance is on some of these key industries, and real estate's obviously right in the nexus of that. And we go from 1 year to the next with an industry being the best friend of policymakers to suddenly being its enemy. And it's really, really unclear at this stage how orderly the adjustment in this sector is going to be allowed to be. But certainly it's also really unclear how effective a policy stimulus can be in China if it doesn't really involve the real estate and construction industry.
But Sofia, so are they just holding back and actually waiting to put a little bit more stimulus, at the right time, or are they worried that if they do it too soon, it doesn't actually have the intended effect?
You know, Francine, I think for me, the most interesting part about moving here is actually the questions people ask about China. Why doesn't China bring out the big bazooka? Why doesn't it just bring out more stimulus if it has the tools and capacity to do so? You know, I think there are, as you know, as Guy said, confusions over what that big bazooka would be and whether it would be effective or not. The one thing I think, Francine, that the market is looking at right now and really focusing on is the fiscal transfer to consumers. So anything that consumer checks, because stimulus so far has been focused on the supply side, and China really has a demand side problem. The property downturn is a really important factor of that, because people don't feel good about the economy. They, you know, the majority of household assets are in property, and if essentially your nest egg is losing value, you're not going to want to spend. I mean, that's the last thing you want to do. So very kind of sentiment-driven behavior problem that China needs to fix. I do think that, you know, looking forward, the 20 points that the State Council mentioned this week or last week really got the market excited, because it seems like this time is different. So I do think we're getting a little bit of a narrative, maybe kind of wishful thinking, that this time actually Beijing will deliver the policies that it has been promising all year. But so far, not only have they not been enough, but they've also been ineffective.
But you wonder also whether they worry that if they put them in place, then it really means that they're looking at something ugly. So it's the kind of self-fulfilling prophecy almost, if you do too much too quickly.
Exactly, Francine. But I would say, kind of just to counter the gloom a little bit, there was a huge concern that when China reopened, the post-COVID China economy would bring inflation into the world. And that was, you know, as recently as November, I was having heated debates with people outside China who were saying this, you know, let's worry about the inflation story coming out of a reopened, kind of booming China economy. We don't have that. And China's actually going to export disinflation because producer prices are still very low. So I think there's kind of an optimistic tilt there. China may add to the soft landing disinflation narrative elsewhere.
Yeah, and actually, if you look at a bit more optimism, the chart of the day is looking at foreign investors, Guy, returning to China's stock market en masse. Now, en masse, again, it's overall, it's not a huge amount, but it is actually much bigger than it has been in the last couple of months. And I don't know whether that's because they're optimistic or they're just trying to call bottom.
I think it's the latter. I think we're getting to a stage where the bear case is that China has lost all of the policy measures that it would be able to rely on in the past to drive growth. And the bull case is that that level of pessimism tends to indicate buying opportunities. And when we look at the charts, you know, last week was quite important in just showing that the market's really breaking out of what have been quite a persistent downward trend in China. So I think it is a crucial point to see if that confidence can be retained.
So, Guy, how do you buy into China?
We've got fairly modest but broad exposure across the Hong Kong sort of entry points and a bit of ADR exposure as well.
Okay, interesting. Thank you both for joining us. Bloomberg Sofia Ortega-Costa there joining us on the China market, and RBC Brewin Dolphins Guy Foster stays with us. Lucky him, he'll get to talk about banks shortly. Coming up, HSBC announces a new buyback program as higher interest rates propel profits. So we'll hear from the bank's chief executive. That's next, and this is Bloomberg.
We see great opportunities still in China, here in Hong Kong, but also we see opportunities within India and Singapore. And Singapore, not just for Singapore alone, but Singapore and its gateway into ASEAN. So we're investing equally between all parts of Asia, and we're seeing good performance across the whole of Asia. But also we're investing in new business lines for us. So I think in the past we've underinvested in our wealth business across Asia. We had a very good business here in Hong Kong. We invested in that, but we didn't invest enough in mainland China or in Singapore or in India. And we're correcting that now. And you can see the evidence of that in these results. You know, in Asia, we took in $27 billion of net new invested assets on behalf of our clients. And that, you know, if you look globally, in the last 12 months, we took in $75 billion of net new invested assets into our wealth business. That's a function of the investment program we started over 2 years ago.
So how active are you in helping, for example, to finance still some of the Belt and Road projects?
I mean, we look at all of those projects that are taking place, all of the big infrastructure projects. We're very particular focused at the moment on infrastructure projects around sustainability, new hydrogen plants, new wind and solar, ways to decarbonize. So we're working with our clients across all of Asia, but globally. We've done some big transactions as well in the Middle East, where we're looking to help clients invest in the new technology to build the new greener economy of the future. So we look at them on a project-by-project basis, and some of them are within the Silk Road, the Belt and Road Initiative, but some of them will be outside of that. Many of them will be outside.
HSBC Chief Executive Noel Quinn there speaking to me a little bit earlier about the bank's opportunities in Asia. Now, it's also announced this new buyback program as rapid interest rate, of course, rises, boost profits. We also talked about the UK. Let's get more now with Bloomberg's Tom Metcalf, who oversees all of our banking coverage here in London. Still with us also Guy Foster, Chief Strategist at RBC Brewin Dolphin. So thank you for sticking around, Guy. Thank you for coming on, Tom. I mean, if you look at HSBC, much like a lot of the big banks, they're giving back because they're making more profit thanks to higher interest rates. Is that the kind of the simple answer, like the simple question?
Yeah, I think ultimately at its core, it's a net interest income story, and HSBC, like most of the other lenders we've seen this quarter, you know, those rise in rates boost profits, and in HSBC's case, they've turned to buybacks. They've gone to a second interim dividend. Of course, you know, you hear the CEO talking about the strategy is working, but they probably won't be working quite as well without those rate rises.
Yeah, but at the same time, so we tried to, you know, get him to explain whether they're shifting a little bit away from China to focus on India, and he wouldn't go there really.
Yeah, I mean, look, it's a fraught topic, and you know, they're definitely talking about expansion, not just in China, but ultimately this is, you know, a Hong Kong focused bank, really, you know, mainland China focused. So they're looking at maybe expanding in areas like India, but when you look at the balance sheet, it's still very much, a Hong Kong first.
And he's very committed to the UK, despite actually also saying that they needed a building, you know, half the size of what he had in Canary Wharf.
Yeah, no, that's a fascinating sort of move there and kind of have big implications for the City of London. But yeah, no, look, they've got a huge ring-fence bank. And the way I think HSBC look at it is you've got sort of a pillar of strength in Asia, and then that huge deposit base in the UK as well as another sort of pillar of strength. And then they can kind of overlay various sort of global businesses across those.
Okay, are you invested in banks, either UK or globally?
We have indirect exposure to banks, but it's not like a sector that we really focus on because we tend to have a bit more of a sort of high margin quality sort of a focus on businesses that are slightly more master of their own destiny, slightly less dependent upon the policy environment, as Tom was talking about.
But if you look at some of the European ones, I mean, they look pretty attractive, or certainly pretty cheap compared to the US ones. So is it a business model that you don't really understand because they're so vulnerable to interest rate rises and falls, or is it just because you're seeing more value elsewhere?
Yeah, just better types of businesses really that we prefer elsewhere. But I would agree in valuation terms in Europe and in Japan, I think there's quite a lot of appeal compared to the sort of +1 times book that you see in North America. So yeah, there's definitely opportunities. Hence, we do have some indirect exposure to those markets. I
mean, last time Tom had a full weekend was like in 2018, because there's been crisis after crisis, or mergers, or I mean, there's always something going on in the banking world. Is there a main takeaway of, you know, the challenges, if not regionally, country by country? Yeah,
well, I think it's a special nature of finance, right? Like, you know, we saw with NatWest last week, you know, there is a ton of government sort of attention on this area. So it's just a very difficult, very complicated business. And, you know, you can certainly understand why investors are sort of, sort of looking at these banks going, do we really want to be involved in something which, you know, could suddenly change?
Were you surprised by the strength of a lot of the American banks, certainly compared to some of the Central European ones?
I think, you know, strength of American banks is something I'm now pretty familiar with, and you know, so it was not surprising, you know, JP Morgan's, Bank of America's of this world coming out strong. I think, you know, on the European side, looking quite generally, it's really been pretty positive all round. So similar results really to HSBC with these, you know, buybacks coming through. So on the continent at least, it's looking like, you know, sort of a very positive quarter. And then you look at the UK and it's a bit more of a mixed picture with Barclays down as well as NatWest.
Guys, is there any other sector? I mean, if you're not crazy about banks because they're not masters of their destiny, what sector do you like the most?
Well, I mean, I'll qualify that by saying I do think there's an opportunity in Japanese banks at the moment with the monetary policy change that is taking place there, and based on the fact that actually they are probably the lowest valuations in the world and don't have, despite there being an extensive regional bank sector, it's not got the same sort of regulatory problems that you've got in the US. Insurance, then, we're a bit more kind of constructive on that within financials, but really I think probably more of the growth-orientated sectors, particularly industrials, semiconductor, capital equipment, things like that. So those are the kind of sectors that we've been buying more of just recently.
Okay, the BOJ certainly gave us a little bit of heart palpitations between last Friday and this Monday. What's your take? What do you think the BOJ does until, maybe mid next year? Do they actually move on yield curve control?
Then they have to see how much buying they need to do to keep yields in the sort of 0.6s where they would presumably quite like them to be. In an ideal world, we've just had obviously no take up on the fixed rate buy up. In an ideal world, they end up buying a lot less bonds, and there's a sense that the market has returned to equilibrium. From an investor's perspective, I think we'd like to see them having to work a little bit to keep yields where they are. Because that will make it quite clear where the trajectory of yields is going to be in the future, and that's makes it easier to position for.
All right, thank you so much both for joining us. Guy Foster, Chief Strategist at RBC, Brewin, Dolphin, and of course our very own Tom Metcalf, all over the banks here in the UK and Europe. Coming up, Diageo says it's been able to pass on price increases to consumers as sales beat estimates. So we'll hear from the chief executive of the world's largest distiller next. This is Bloomberg.
We have been able to pass along the price increases that we needed to, but look, we are being very surgical about it. We're seeing inflation kind of moderate as we go forward, so that should help us kind of navigate this and not have to take so much pricing. But we do watch this carefully. We do have a lot of other levers, though. As I mentioned, we have a lot of aged product. Aging, of course, helps us.
So Deborah, is this the end of price increases then? Are you going to do any more then? If you do see inflation coming down, is this the peak of that?
Look, I mean, we have to see what's in front of us, and we'll navigate that, appropriately.
Deborah, I am impressed how you managed to mention putting consumer at the heart of all your decisions in a conversation about price increases. But that is a good sales pitch. I'm curious, you talked about the premiumization you're seeing within your brands generally globally. Are you seeing that ongoing premiumization from the consumer in China as well?
Yeah, I think, look, in China, I mean, China is still, it's small for us. It's largely an opportunity. What we saw in our results this year, we're one of the few Western companies with the Chinese white spirits business. That was quite negative for us this year because of the lockdowns. Baijiu, Chinese white spirits, is mostly consumed in banqueting and gifting. So these activities were just shut down, and they're really just coming back. Actually, underneath of that, our Johnnie Walker and Scotch business was up double digit. So, we're seeing kind of China come back. It's a little bit slower than what we expected, but we're seeing that come back. And we feel good about the opportunities in that market.
Deborah, where I am here in the UK, increased alcohol taxes are coming to the region. Do you see that affecting demand at all?
Yeah, I mean, look, we had said to the government back in March that this would be a hammer blow ultimately for hard-pressed hospitality. And ultimately the consumer. So, it certainly will be a headwind for us, here in Great Britain. About 75% of every bottle of whiskey that you buy in GB goes to the government.
That was the Diageo Chief Executive Officer, Deborah Crew. Their shares in the world's largest distiller higher this morning after Diageo actually reported sales that beat estimates. So let's look at Diageo, but also the other two big companies that reported earnings today, all on the higher side. So if you look at HSBC, they announced fresh buybacks. Higher rates definitely propelled profits that were around $8.8 billion for HSBC, getting some 2.7%. Diageo shares up. Again, the distiller able to pass on some of these higher costs to consumers. And then BP recaps some of the big oil earnings with a focus on cash for investors. The other story watching out for is BMW. Those shares are falling. This is after they warned that parts expenses will weigh on some of their cash flow. BMW down 3.8%. Now, coming up, we'll have a good and exclusive conversation with Bernard Mensah. He's Bank of America's president of International, to discuss the new Fed rules around excess capital. We'll also talk about the way forward for banking internationally. This is Bloomberg. Well, China's factory output unexpectedly contracts in July. Home sales dropped the most in a year. Beijing pledges to boost private credit. BP raises its dividend by another 10% and says it will buy back another $1.5 billion of shares, despite missing profit estimates with weaker oil and gas prices, plus another $2 billion in buybacks for HSBC shareholders, as the bank's second quarter pre-tax profit actually beat estimates. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So it's been a strong earnings season for Wall Street, despite tighter credit conditions and the upheaval from the collapse this year of the 4 U.S. regional lenders. Now, Bloomberg Intelligence says tougher regulation from the Fed can now raise $126 billion of excess capital at the biggest U.S. banks. Well, joining us to discuss this and much more is Bernard Mensah. He's Bank of America president of International. Bernie, thank you so much for joining us. There's so much to talk about right now in the banking industry.
Thanks for having me on.
It's an absolute pleasure. When you look at a lot of customers, when you look at what's in the pipeline in terms of IPOs, in terms of revenue growth, where do you see the green shoots coming from in the next 6 months?
I think the green shoots are broadly the fact that the market is assuming that the Fed might be near the end of its cycle. So there has been excess savings, excess capital. The question has been, when does it get put to work? We're about halfway through the reporting cycle of U.S. investment-grade companies, I think, around about now. And I would say that there's been something like 4 to 4.1% beat in terms of upside surprise. It was about 5.5% in the last couple of quarters. So things are not looking too bad. I think corporate balance sheets are in a good place. And they're really waiting for the capital markets to open up. Yeah, so
when will the capital markets open up? And what I keep on hearing is that actually in terms of deals and IPOs or even M&A, there's a mismatch between what some of the sellers want in terms of pricing and what people are ready to pay for them. Does that match up at some point?
Well, I would say we're super busy, and our pipeline is, and so there is this pent-up demand. In terms of the market pricing, it's been really a question of, sort of liquidity and where you can get your deals done. Some of the pricing mismatches have probably been more in the private markets and in specific sectors where there were very high valuations before, and there's some valuation adjustment that's needing to be taking place. But I think in the public markets, it's really a question of when the markets open up and where you feel you can get your deal done.
Yeah, and this happens, it's of course about inflation, what the Fed does and the U.S. economy. Are you optimistic about the U.S. economy and the world economy in the next 12 months?
We have, our research has been postponing the U.S. recession for a few quarters now. They now tell me that, perhaps a couple of quarters next year might be a gentle one. We've always seen the U.S. consumer as being in a very good place and a very robust place. So that's always given us a certain confidence that the underlying economy is doing well. Unemployment levels at 3.5%. And we have, at Bank of America, a very good perspective on the U.S. consumer. So that feels good. I was in Asia last week. I was in Japan and in Korea. Now, there was a sense that the Chinese economy was a little bit slower than we generally expect. I was talking to a very senior person there who was saying that generally it is surprised to the upside, and for the first time he thinks it might surprise a little bit to the downside. But beyond that, I think generally things feel reasonably decent.
So you don't see any stress in any of your customers or consumers in the U.S. or elsewhere?
It's really interesting. The CEOs and the senior corporate executives I'm seeing, they're an incredibly, I think, impressive crew. They've managed through a bunch of different crises recently. I think they're on the front foot in terms of technology, in terms of things like the Inflation Reduction Act, in terms of where the global economy is. They're on the watch out for stresses, whether it's commodity markets, whether there's specific macro things like in Japan, you just had this sort of slight change in yield curve control type issues there, what the Chinese economy is doing. But people seem to be on the front foot. Right as of now, it feels as if we've come through, perhaps we've come through the worst. Let's see.
Bernie, when you look at some of the new rules that actually could apply to U.S. banks in terms of regulation, what does it in effect mean on how the bank is run or where you focus your attention on?
Yeah, so we've been anticipating this for a while. We in the banking sector feel that we're very well capitalized. We go through our annual stress test, and I think we've sort of proven that. The new rules will mean a reallocation of resources. It'll make certain instruments and certain activities more expensive and others less. We believe our peers are in a good place to manage through that. Some of the aspects we think are a little bit of a shame. You know, the trend was heading towards more model-based approaches, and it feels as if what's colloquially called the Basel III Endgame, or the expanded model-based approach, is a little bit less of that. So we'll manage through that, but we'll have to be sensitive to the fact that different asset classes and different types of activity will be more or less expensive.
Are you expecting regulation to stay the same in Europe? There doesn't seem to be anything that could change, but I guess that's one of the biggest concern for banks, that suddenly there's, in the UK or elsewhere, a kind of realization that things could be done differently.
Yeah, well, with respect to the Basel rules, the EU seemed to have had its arguments a little while back, and there's a lot of debate around the output floor. And just in the last 4 to 6 weeks, a settlement was reached with the Parliament and with the EU and the Commission. So that's sort of in execution mode. And my sense, there might be better experts there, is that what the capital cost is anticipated to be hasn't changed so much in the EU. I think it's in the US where the rules have just landed, and there's lots of reports as to whether it's an 18 or 20 or 22% increase. And that will differ from institution to institution.
Bernie, it's also really interesting, and Bank of America is a great benchmark to try and understand some of the underlying growth prospects for individual countries. I don't know how Europe feels right now. And again, when you look at the PMIs, when you look at a lot of the data, it's quite contradictory. What are you seeing on the ground?
I think in Europe I'm seeing, we're predicting something like a 0.5% growth rate for this year, and a slight increase, maybe 0.7% next year, one. Two, I think Europe has adjusted through the energy crisis quite well, and actually has accelerated investments in renewables that over the medium term should be less expensive. Three, a lot of the corporate C-suite have been seeing, I've spent quite a lot of time in Europe recently, had been focused quite a bit on the Inflation Reduction Act that came through. And there was a sense maybe 6 to 8 months ago that that's where investment is pointed. But the EU itself, with its EIC, I think, which they have put together, is countering that to some extent. My argument was never a question of the amount of money. Europe has a huge amount of money, whether it's from the SURE program or other financial resources. I think the real point for the EU to focus on was speed of execution, speed of approvals, making it easy to access whatever incentives there might be. And I think there's been some progress with that.
But we speak to CEOs, and actually the Inflation Reduction Act is such a catalyst for a lot of the investments. You're even hearing from European chief executives saying, well, actually, I'd want to invest in the US and certain states first and then look elsewhere. Are you seeing this pattern, and is it certain sectors, or is it almost across the board as long as they can tap into the Inflation Reduction Act? Yeah,
so exactly that. I would say 6 to 8 months ago when I was in Europe in Q3, Q4 last year, there was a lot of talk of that. And perhaps we are Bank of America to some extent, although we're as big and local here and very global, but a lot of people are asking about the possibilities there. I'd say that has shifted a little bit, where there's a little bit more of a realization of the opportunities within the EU itself. And as I mentioned earlier, I was in Asia last week, and there's a big focus there, perhaps a little bit more on the US than on Europe. So if there's a relative balance, I would say the US benefits from EU interest and East Asian interest, and perhaps the EU doesn't have as much East Asian interest in EU possibilities, and maybe that's the next step for European regulators to think through.
Is there any part of the world that you're looking at hiring right now quite significantly because you want to grow out a business there?
I would say that, with respect to our headcount, we've tried to manage that. Our industry has seen a lot of announcements about headcount adjustments, as it were. And we've tried to manage that by just reducing our rate of hiring and redeploying our crew. Because every year we hire thousands, tens of thousands of people. So what we try to do is to say, well, let's lean into the attrition, because we have people leaving and we have people coming. So we feel good about the fact that we've managed that process well. And what we've tried to do is to redeploy resources that we have, excellent resources where it's less busy to areas where it's a little bit more busy. I mean, we saw big reductions in capital markets, but that might come up again. Globally, we are really well balanced. We feel really good about the places that we're in. We're incredibly global. There's very few financial institutions of our scale to be able to operate on the scale that we do for our real global clients. And we move with a different sort of GDP growth prospects as we can.
I know we'll talk about AI and technology in a second, but what's your take on the UK right now? So it seems to be an economy in transition, and so I don't know what that means for a big US bank here.
Yeah, so I guess the UK has it. The Bank of England has its rate decision this week. The markets are pricing.
Knife edge.
Yes.
It's quite exciting.
Yes. Well, I tend to look at what the markets are pricing. I think it's, I don't know, somewhere between 35 basis points. We'll see. The inflation outlook felt a little bit stickier here than elsewhere. I do think all global economies do need to think through the supply side as well as the fiscal side and the monetary side of things. And the UK absolutely needs to do that as well. For us, as a global financial institution, we're here. It's our largest country that we're in outside of the US with respect to investments in Europe. Recently, we made a lot of investments in France and actually in Germany and in Italy and in Scandinavia, where I was a few weeks back. But the UK remains, whether we're in London, we've got 1,200 people up in Chester. And so it remains a really important base for us.
All right, Bernie, thank you so much. Bernard Mensah, Bank of America's President of International, stays with us. We'll talk a little bit more about the UK, and we'll also talk about technology and AI. That's coming up shortly, and this is Bloomberg. The conversations that matter, the insights you need. This is a Pulse, and I'm Francine Lacqua here in London. Now with me on the show today, Bernard Mensah. He's Bank of America's President of International. Bernie, thank you so much for staying with me. We had a good conversation about some of the capital markets, what you're expecting some of the clients to do and to behave. We talked about, I think, inflation. We started talking about the UK. Now, some of your rivals have decided to go full in and actually have a retail presence here in the UK, either digital or actually with branches. Is it something that would tempt Bank of America?
No, we don't have any plans for that. We have a huge retail business in the US. We think it's a best-in-class business. And I do think if we wanted to do that globally, we would be very good competitors, but it's not our strategy right now. We have a great wealth business that's in the US as well. So internationally, it's our corporate banking, our investment banking, our sales, and our trading business.
What about payments?
Exactly. That's really a part of our corporate banking business, our global transaction services business. We're super excited about that. It's a top 2, top 3 player globally. It's often not talked about. It's often not as, whatever word I may use, glamorous perhaps as some of the other businesses that we do. But we provide an excellent service, technology-based, digitally based, and it is often the first conversation we have with growing companies and with large global players, whether it's the US large companies going global or large Asian or European players. It's a terrific product, and we're very excited about the power of that franchise.
You mentioned glamorous businesses. We talked about how you're traders. That's a pretty glamorous business. Are they going to do as well as last quarter? How's it looking?
Well, it's interesting. We had a really good quarter last quarter. We outperformed pretty much all of our peers. And if you go over the last 2 or 3 quarters, we've continued to do that. We put more resources into that space. We have, again, a terrific global franchise. We have a best-in-class research platform, top 1 or 2 every year, and II, etc. So that underpins the global offering that we give. And those trading businesses and the franchise that drives that is really driven, I think, by the global platform we have and the breadth of the franchise that we're constantly building. You never know what the markets will give you. My background is in trading, but we feel really good that insofar as our clients have questions to ask about where the economy is headed in the macro space, and what the corporates need to do and what our capital markets can bring to the table, we're just as competitive.
I mean, as a markets guy, and I think if you're a markets guy, you're always a markets guy at heart, right? What do you find bizarre at the moment in the way that bonds or equities are behaving?
I'm not sure if I'd call it bizarre. I think what I what I might say is that I worry. You're always worrying a little bit as a markets person. What can come and trip you up? Yeah. And so at the moment, you look and you're sort of thinking, what are the clouds in the sky? You're searching for the clouds. And so there are a bunch of macro backdrops that you sort of think should worry you, but things seem okay. So so I think that's what just keeps me up a little bit. We saw in Japan the slight move in yield curve controls. We'll see what happens with corporate earnings seem to have been okay. Inflation, the idea of a Goldilocks landing is something that I didn't, not that I didn't believe in, but you're sort of skeptical about. And I think that some of the fast money managers had also positioned a little bit, not anticipating that. So I think it's more that.
Brewin, when you look at technology and AI, how does it change banking, and how is Bank of America going to use it?
Yeah, well, I think it changes us in a number of ways. Internally, of course, we lean into all the new technologies. We've used a lot of machine learning processes. If you take, for example, our voice-activated Erica sort of platform in the US. And then with respect to AI patents, for example, we've, I think, registered more than anybody else. So we're leaning into the new technologies. But importantly, we think it'll change things for our clients. I think it'll disrupt some businesses and some economies. And I think we need to be very alert to what the impact might be, down the line. So something that we spend quite a lot of time on.
So this is what, maybe voice recognition that gets used in bad ways if there's an AI algorithm? Like, how do you, at this point in time, where we're not sure where we end up in AI, look at the good thing with AI and how it can help banking, and the things that you should really worry about and spend more money in trying to prevent it?
Absolutely. So on a bank of our scale, you've got things like the cybersecurity aspects, you've got voice recognition aspects to it, but then you've also got consumer interactions that can help you with. And then what we have are, in a bank like ours, huge amounts of very high-value data sets, large data sets that could benefit from machine learning or sophisticated machine learning AI-type applications. And I think that's where we need to think through. And then further on, for our clients, which is who we're here to serve, really thinking through what that might be. We host a breakthrough tech event that we've been doing for the last couple of years. We had one a couple of weeks back. And a lot of that was to step back and sort of say, what happens over, what happens tomorrow, fine. We discussed that a lot, but that process also allows us to step back and say, what happens over 5, 7, 10 years? What are some of the things that might come at us that we don't anticipate?
And so what does, again, when you look at banking, does it lead to job losses, or does it change the nature, for example, job at bank tellers because you use an AI kind of algorithm or person to do that, and so you create more quality jobs?
Absolutely. So that sort of machine or automation has been in place for a long period of time. When I started in the industry, we had a lot more FX traders for a lot smaller amount of flow. Now we have, and not just us, others have auto-coding, auto-execution algorithms. There's legislation around that. We need to manage all of this well. So I think that has happened. If you look at our retail space in the US, the number of new retail accounts and digital accounts that we're able to take on every week, every month, we couldn't do that without the help of machines. So I think that's already happening, and so it allows us to invest and grow in other areas, and it allows us to manage increased capacity with what we have. I think we have something like 18 to 20 million users of Erica constantly, over 100 million interactions monthly, quarterly. So that is already helping us to be super efficient, super productive. What we're really trying to think through is what's the next stage, as you were asking before. How can we use that to really drive further interactions, whether it's on the research side, whether it's on AML, KYC, and I'd say one of the most exciting things for me around AI is actually the coding enrichment. The fact that you have applications that allow you to ask in normal language for coding for certain activities. So it means that the huge amount of money that we spend in basic coding can be automated, which frees up those computer scientists to spend time on other things. So I think part of my point on the AI sort of
revolution
out there, is that it's a lot more subtle.
Yeah.
I think it'll be a lot more diffuse.
Yeah.
I think the impact will be a lot broader, and we won't realize it over a period of time. And the piece where we see it, which is going into ChatGPT-4 and asking it a question, I suspect will be a small part of what it's all about.
So interesting. Bernie, thank you so much for joining us. That was Bernard Mensah, Bank of America's president of International. Coming up, BP also follows the pattern set by its big oil peers, returning more cash to shareholders despite a profit miss. So we'll have the details next, and this is Bloomberg.
In terms of valuation gaps that people speak about, not necessarily within the European companies, but versus the United States, it's simply a question of focus and delivery. We've got real plans to grow this company materially over the next couple of years. Between now and 2025, we intend to bring on 200,000 barrels a day of new production from new oil and gas production from major projects. We're going to double our biofuels production. We're going to double our biogas production. We're going to grow the business, and a business in our growth engines that was delivering $700 million just in the first half of this year will be delivering $3 to $4 billion by 2025, and indeed $10 to $12 billion by 2030. So this is a growth story. This is about execution. This is about focus, and that's what we're set on doing.
Bernard, when it comes to the execution of your traders, you point out another exceptional quarter for gas trading, though softer than the first quarter. How much softer? What was the difference between these two quarters for your trading units?
Yeah, the trading organization in gas in particular had a very good quarter, an exceptional quarter, as we called it. A little bit less than the first quarter, but still exceptional, as we say. And it's really just a characterization of a slightly lower volatility in the markets in the second quarter than there was in the first quarter.
What's your outlook on demand on both oil and gas, particularly coming into winter? Are there any particular regions where you're kind of worried about the demand strength?
You know, I think there's a lot of talk, obviously, about concerns about the global economy. There's a lot of talk about concerns about China growth. In spite of all of these things, demand for oil has been incredibly resilient. In fact, there are some reports that say oil will reach its maximum demand ever this year. So we're expecting over 2 million barrels a day of growth in demand for oil this year, which is very strong when you look back in history. And we expect that demand growth to continue into next year.
Well, that was the BP Chief Executive Bernard Looney speaking to, of course, our team this morning, Mark and Danny, on the company's outlook. The BP is returning more cash to shareholders, even as its second quarter profit fell by more than expected. And the other big story this morning was the RBA. If you look at what Aussie dollar is doing, we have it on the screen. Look, the Australian dollar really extended an intraday slide, falling some 1% after the RBA earlier this morning unexpectedly left the official cash rate unchanged at 4.1%. So that means traders are now paring bets on further tightening, seeing around a 40% chance for a hike by October. This is Bloomberg.